All right, let's get right into it. Today, we are digging into what was, frankly, a real head-scratcher of an earnings report from Bakkt for its third quarter. This thing had a little something for everybody. The bulls, the bears, and the way the market reacted tells a really fascinating story. And it all starts with one pretty brutal number. So, on the day Bakkt dropped its numbers, after all the dust settled, the stock got absolutely hammered, closing down a rough 11.4%. That seems like a pretty clear verdict from Wall Street. But what makes this so interesting is what was going on underneath the surface. Because at the very same time, the company reported this, a massive 241% swing year over year into positive adjusted EBITDA. Now, that's a key profitability metric that kind of strips out all the accounting noise. It's meant to show you how the core business is doing. And what it showed was that, well, the business actually looked like it was finally making some money. So what gives? How on earth can a company show that kind of massive improvement in its operations and then watch its stock just get crushed? That is the big question we are going to unpack today. Was this a huge beat or was it a big miss? Well, the truth is, it was kind of both. So here's how we're going to break it all down. First, we'll look at that confusing snapshot of the headline numbers. Then, we're going to solve the mystery with what I'm calling a tale of two ledgers. After that, we'll get into management's new picks and shovels pitch, try to understand the market's final verdict, and then I'll give you our take on what to watch for. All right, first up, the confusing snapshot. The whole reason this quarter was so messy is because the headline numbers were just pointing in completely opposite directions. It was a total contradiction. And you can see it perfectly right here. On one side, you have their official by-the-book GAAP earnings. That came in as a loss of $1.15 per share, a huge miss versus what analysts were expecting. But then you look at their adjusted earnings, and it was a profit of $1.21, a messy beat. That right there, that's the disconnect we have to figure out. And you could literally watch this confusion play out on the ticker in real time. Before the market even opened, the stock shot up over 6%. The trading algorithms probably latched on to that positive adjusted number, but as the day wore on, the humans took over, a different story took hold, and the stock did a complete 180. Closing deep in the red on almost 4 times the normal trading volume. That's big money making big moves. So to figure out why the stock reversed so hard, you have to dig into that huge gap between the official accounting and their custom adjusted numbers. This quarter was truly a tale of two ledgers. Just look at that, side by side. A GAAP loss of $1.15 and an adjusted profit of $1.21. I mean, that is a difference of almost $2.40 a share. So what on earth could cause a gap that big? Well, it all comes down to one single non-cash accounting item. The culprit is something called a warrant liability charge. Now, it sounds complicated, but here's the deal. It's basically a paper-only expense. No actual cash is going out the door. The ironic thing is, because Bakkt's stock price had rallied before the earnings report, the value of their outstanding warrants went up. And weirdly, accounting rules say you have to book that as an expense. So they get punished on paper because their stock did well. Kind of backwards, right? And we're not talking about some small number here. This charge was a whopping $37.2 million. That one single item, that paper loss, is pretty much the entire reason the company posted that ugly GAAP loss. And it's exactly what management stripped out to get to their positive adjusted number. So you can imagine what management's saying, right? They're telling investors, hey, ignore that accounting weirdness, look at the actual business. And to be fair, they had some good points. The company has no long-term debt, a healthy $64 million in cash, and maybe most importantly, their core operating costs are down over 18%. This is the picture of a much cleaner, leaner operation. And all this operational cleanup is part of a much bigger shift in strategy. On the earnings call, management painted a whole new vision for Bakkt. They're basically saying, forget the old consumer app, we're now the picks and shovels provider. Think of it like the gold rush. They don't want to be a miner. They want to sell the tools to all the miners. The CEO himself, Akshay Naheta, put it pretty bluntly. He's signaling that the really painful part of fixing the business is done. The message is clear. Now it's all about growth. And they've laid out exactly how they plan to do it with 3 new growth engines. You've got Bakkt Markets for the big institutional players, Bakkt Agent, which is their AI and stablecoin payments platform, and Bakkt Global, which is their plan to expand internationally without spending a ton of money. And then, to really hammer the point home for long-suffering shareholders, the CEO made this promise. He's directly addressing the fear of dilution, of the company constantly selling new shares. This was a clear signal that they're now focused on creating value for shareholders, not just growing at any cost. So, if the story's so good, why did the stock tank? Which brings us to the market side of the story. Despite the good-looking adjusted numbers and this new turnaround pitch, investors clearly hit the sell button. Understanding why is absolutely crucial. Well, first off, context is everything. Just look at this chart. In the 3 months leading up to this report, Bakkt's stock was on fire. It was up about 75%, while the rest of the market was up just 7%. The stock had already priced in a lot of good news. This is a classic case of buy the rumor, sell the news. But it wasn't just profit-taking. There were some real worries here. Investors looked at that huge gap between the official and adjusted earnings and questioned the quality of the beat. That whole warrant accounting thing just muddied the waters. And a lot of people felt that this new 3-part strategy, while it sounds great, has a ton of execution risk. The market was basically saying, that's a nice story, now go out and prove it. Okay, so with all of that in mind, where do we go from here? Let's get to the final section, our take on what's next for Bakkt and what we'll be watching for on the next earnings call. The good news is management has given us a very clear roadmap of what to look for. They say the transformation will be done in Q4. Then, between now and early next year, we should expect new partnership deals. That'll be a huge test. And it's all leading up to an investor day in the first quarter of 2026, where they've promised to finally give us the key metrics to judge their progress. So, after weighing everything, the good, the bad, and the confusing, we're initiating our rating on the stock as market perform. And here's the thinking behind that. The story, it's compelling, for sure. And having no debt on the books is a huge plus. But, and it's a big but, the execution risk here is really high. They have to prove this new model can generate real, clean, sustainable profits. Until we see that happen, the risk and the potential rewards seem pretty balanced to us. Now, for those with a higher appetite for risk, here's a more speculative idea. That big 11% drop in the stock likely crushed some of the implied volatility, which might have made options a little cheaper. One could look at some long-dated call options that expire after that Q1 2026 Investor Day. It's a way to bet on the turnaround story with a defined amount of risk, hoping they deliver some great news at that event. And of course, as always, this is not financial advice. This is just our analytical breakdown of a very complex but definitely fascinating quarter for Bakkt.